Hi, I'm Glenn Berkins with QCity Metro, and welcome to another edition of Expertalk. Buying a home can be one of life's most rewarding experiences, but it also comes with questions and quite a few challenges, especially for first-time buyers. That's why we are once again talking about the home buying process with David Havlik. David is a mortgage banker with SouthState Bank. Welcome back, David.
Thank you, Glenn, for having me. Good to be back with you.
SouthState Bank is the sponsor of Expertalk, so we thank our sponsor. So, David, we're talking about buying a house. Today, specifically, we're talking about income. What income qualifies as qualifying income, if you will? Why is that important?
So income is probably the most important component when purchasing a home. After the real estate crash in 2008, 2009, the industry essentially revitalized itself and how people qualify to purchase homes. And from a regulatory perspective, a new component came in called ability to repay. In other words, ATR. And it is now, we now as lenders, brokers, bankers, anybody who's writing a mortgage has to document that the borrower has the ability to repay the loan that they're requesting under the terms of the product that they're qualifying under. So as far as being able to document your sources of income, and there are many sources of income, and there are different ways to document different sources of income, but it really is the most important piece to the puzzle. And in large part, that's why we have not seen anything remotely close to the 2008, 2009 crash, because we are now heavily focused and required to be focused on being able to document where the sources of income are coming from for the borrower or borrowers to repay their loan.
So when I think of income, I think of a paycheck from an employer. What other types of income might there be?
Great question. There are a number of different types of income. I mean, so you have, as you stated, W-2 wage earner income, and within that, you have multiple different types of income, right? You might have somebody that's an all commission salesperson, or somebody that has a base salary with a discretionary annual bonus. But all of those individuals, tend to be employees of a company. Outside of that, you have income, various types of income if you're self-employed. And the structure of your organization, of your company, will determine in large part how you receive income. Outside of that, there are capital gains income that we can use, or dividends. You have alimony, child support can be used as qualifying income, Social Security income or disability income, other forms of retirement income like pension. And then there are also a royalty income. If somebody has a contract that receives royalties, that can be used as qualifying income also.
I think you mentioned capital gains from investments. When I think of capital gains, I'm thinking more of a one-time thing where you would maybe use a capital gain to make a down payment, but you're saying that can also be counted as income toward your monthly mortgage?
It can. So the requirement for things like dividend income or capital gains is that there has to be at least a 2-year history of receiving those gains. The industry standard is that we average those 2 years together. And we also have to then verify that the assets that are producing those gains, that you still own those assets. So that is in general how we would qualify somebody that is living off their capital gains, but or living off their portfolio, if you will, but may not be of retirement age and have a defined distribution out of, per se, a 401k or an IRA.
That's a situation I wish I had.
Yeah, that's not many people are in that situation, but they are out there. That is true.
Well, let's talk about a more common situation. Self-employed. People are self-employed. We talked before the broadcast about self-employment income and how that income is calculated as it fluctuates year over year.
Yep. So with self-employed borrowers, most products and also the industry standard is that we look at the most recent 2 years tax returns. We look at the net income from the business. However, we can add back, we look at the net income over 2 years, we average that out, and then we can also add back to that income any W-2 income that you may pay yourself as an operator of the business. So we give you credit for that. We average that number over 2 years. We also can add back what we would call non-cash items. These are things like depreciation, where you, for example, let's say you own a trucking company and you depreciate the value of your trucks on an annual basis. Well, you're not really losing dollars, you're not losing money, you're claiming that you've lost value or usable life from an asset. That can be added back to that net income number because it's a non-cash item. You're not losing, it's not an operating loss. Dollars are not lost, if you will. So that's how we calculate self-employed folks. There are instances where 1 year self-employment may be acceptable. That is going to be very product specific to the client. And that's also going to be taken into account with some of the other factors of their loan, maybe down payment, credit score, reserves, money left over after closing. We look at all that if we're looking at maybe making an exception for going 1 year self-employment instead of the standard 2.
But the standard is 2.
The standard is 2, and that's effectively an industry standard.
So we're coming out of a pandemic right now where well, hopefully, knock on wood, where where COVID-19 and related restrictions put a dent in some businesses.
Yeah.
How does that factor in, if at all? Some people may have gotten PPP loans or PPP payments or whatever. How would that factor in for a small business owner?
Yeah, great question. You know, we've dealt with a lot of that, right? Last year, 2020, and of course this year to date, 2021. What we've done, and I think what is, you know, I will say this: the 2 year standard generally still applies. That's where we're going to go first. Now, if we run into a situation where we'll say somebody's 2020 tax return, you know, is not fantastic because maybe they were forced to close down, that kind of thing. What we will then do, or what I've seen banks do, and what we've done in the past, is we've gone, well, here we are 2022, right? So we generally right now, we're going to look at 2020 and 2021 tax returns. But so let's say, for example, 2020 is not great. You know, 2021, we're recovering, we're trending again, right? We're moving in the right direction. Self-employment is all about trends. We want to make sure that the revenue is trending, the net profit's trending positively, right? What we might do is we might go back to 2019, right? And then average that in, see where they were in 2019, maybe compare that to 2021, and then also compare that to year to date 2022 on a profit and loss and maybe balance sheet to kind of gain an understanding that, you know, the business is healthy, it is moving in the right direction, the profits are there, the revenues are there, the expenses are not out of control, and that's how we would look to maybe smooth that trend line out.
Okay. We talked about W-2 salary, but there are people who get a paycheck, but with a set compensation, but they also may get commission, or maybe they work at a company that gives annual bonuses. How is that factored in?
Good question. So we will always give you 100% credit for whatever base salary you have. That is what happens. Now, when it comes to variable compensation, such as commission, bonus income, even overtime income, the bank will average, they will break out that component of their income and average that over a 24-month period, and add that to the base salary as qualifying income.
Okay. And what about non-taxable income? What categories would fall under non-taxable income, and how is that factored in?
Non-taxable income. So the mortgage industry qualifies everybody on their gross income, right? What is your income before you pay Uncle Sam? And so in order to create a level playing field with folks that we'll say have a W-2, for non-taxable income, they receive a multiplier effect of 25%. So if you receive Social Security or maybe disability, Social Security disability, there are VA benefits that are non-taxable that our veterans receive. All of those types of income, we apply a factor of 25%. So for example, if somebody is receiving $1,000 a month in Social Security income that's non-taxable, we would give them credit for $1,250. And that's where we level the playing field with folks that we're assuming essentially that it's a 25% tax bracket, and you get a higher qualifying income for that.
David, I've known people who have taken on part-time jobs for the purposes of buying a home.
Mm-hmm.
They have a full-time job, but they may also have a part-time job trying to accelerate down payment, whatever. How is that factored in, especially if that part-time job may not be a permanent job? How do you look at that?
Right. So when we're writing a loan, right, we're writing a loan for, so in most cases, 30 years, right? Some people take a 15-year, some people take a 20-year, all different types of products out there. When it comes to part-time work, the underwriters want to ensure that the borrowers, if we're going to use that part-time income for qualifying, the underwriter wants to make sure that that borrower has a successful history of managing 2 jobs simultaneously for 2 years. Because if we're going to use that income and that income is, used to repay the mortgage, we want to make sure that, that it's likely to continue, right? Because we have a 30-year mortgage out there, or a 15 or 20-year mortgage. But we also want to make sure that you've had success in the past at managing two jobs successfully. So what we would do with your full-time job is we would, calculate your income just as we've talked about. For a part-time job, we would average that income over a 24-month period if you've had that job for 2 years. It doesn't necessarily have to be the same job for 2 years, but we need to know that you've had a history of working 2 jobs simultaneously for 2 years, and then we can use that income.
Okay. Well, speaking of the same job, let's suppose that someone has just started a job and they don't have a long track record of employment at this particular company. Does that complicate the equation?
Not necessarily. What we look for is, now if somebody's starting a new job, let's say, for example, in their last job, they were, base salary only. They're moving to a new job that is also a base salary, but it has a bonus component to it. We would only be able to use what that base salary is at their new job to qualify. We would not be able to calculate or qualify with any bonus income that is to come, if that makes sense. So we'll also look to see, are they in the same line of work? Are they making a transition into a new industry? We'll also be concerned with Have there been any gaps in employment? And if so, what was the cause of that gap in employment? We just want to we've got to kind of understand what the most recent 2 years looks like. Were you in school, or, are you coming from one job to a next, and that kind of thing.
And so you would look at the income earned from that previous employer.
We would, but it wouldn't be used for qualifying. We would be using their current income for qualifying.
Okay. What about people who are in the military?
Military folks have lots of different types of income. They receive effectively a paycheck from the military, whatever branch of service that they're in. However, within that paycheck, they receive their salary, but they also receive, maybe the best word is stipends. They receive a housing stipend. Their housing stipend is non-taxable for the military. So we can apply that 25% factor to that component of their income. They may have deployment income. They may be deployed. And it will list all of it out. So military income can be a little tricky because there are multiple components of the income depending on, are they deployed? Are they on leave? Are they, but there are some non-taxable components to their income that we can, gross up by that 25%.
We say this, we've said this on every segment, but it sounds like if you're in the market to buy a house, it pays to do some planning ahead and go in, find a mortgage banker, sit down and have some early conversations.
Absolutely. I mean, the place you need to start with, especially in today's market, right? It's the market has cooled a little bit, right, as rates have risen. But our Charlotte metropolitan area is still really hot. And so you want to get in and you want to start with the money so that you know where you're comfortable on a monthly basis. You want to not go out and find a house that you fall in love with and then come to the bank and realize it's not going to work for us financially, or we don't feel comfortable with that number. The rates are moving quickly these days. You want to stay abreast of that. You want to stay in contact with your mortgage banker, really on a weekly basis if you're out looking at homes and shopping around, because we've just seen a lot of volatility in the interest rate market, and we kind of expect some of that to continue for the next quarter or two. Overall, I mean, it's still a great time to buy a house. Honestly, it's really going to continue to increase value here in Charlotte and really the whole Southeast corridor of the United States.
What are the average mortgage rates today, given the Fed's actions?
Yep. So your 30-year fixed conventional loan, a conventional loan is a loan amount that is below $648,000. Those rates are sitting right around the 6% number today. Maybe a little bit lower, a little bit higher. Your jumbo rates, any loan amount above that 648 number, those rates are a little bit lower, somewhere in the mid fives for 30-year kind of fixed rate money. So that's where that is currently.
So we got some bad inflation news yesterday. It's very likely the Fed is going to raise interest rates again. Some people are saying by perhaps 3/4 of a percentage point. If someone is looking to buy a home, what advice would you give them? Should they rush out and try to beat that next interest rate hike, or is that already factored in into the soup?
So with yesterday's inflation data or this week's inflation data, I think the general consensus of the market is that the Fed will raise by 3/4 point or 75 basis points at their next meeting. I think the market has priced the majority of that in already, especially given the inflation data this week. So I don't know that I would never tell anybody to just rush out and buy what would be your largest investment, right? You want to be intentional about it. You may want to be more intentional in a faster nature, but you don't just want to jump on it. What I tell folks is, marry the house, date the rate. You buy the home you love and the location you love. At some point, we're going to work through this inflationary period that we're in, that we've got all worked through, and then you're going to see the Fed begin to pull rates back, and that'll provide an opportunity for homeowners to refinance down the line. On average, homeowners probably refinance every 3 to 5 years, depending on their, or sell. You may not be in that home. Your life and financial needs may change, and that may cause a need for a different home or a different loan. So you got to kind of check in, understand the market you're in, see what's happening, make sure your house is livable for you. But it is still definitely a good time to buy, for the foreseeable future, honestly. I'm still a buyer myself, a little bit more intentional, but definitely it's the best place to be, just from an investment perspective, because it'll also hedge inflation as well. So it's still a good time to buy.
Okay, that was David Havlik, a mortgage banker at SouthState Bank. David, it's always good to talk with you.
Thank you, Glenn. I appreciate your time. Have a great day.
All right, you too.
Thank you.